Hello hackers, it's Chris, Life 180. Today we are talking about, what do you know? I just am on this tear, Index Universal Life. Listen, there's a lot of things going on right now. I'm going to give this room a second to fill up. I've been getting a lot of pushback lately. I've even had some videos recently with David McKnight. We've been engaging back and forth on Instagram. It's very interesting, actually, that whole dynamic. Speaking of that, that dynamic of IUL people that refuse to debate me. There's one guy, his name is Brian, and Brian Jarrell, and he's offered to debate me. The challenge is like there's just not much in it. Like I don't know his background. He talks a lot. He talks like he knows a lot, but he's been in the business for like 3 years. And so it's hard for me to really want to debate somebody that has been in the business for 3 years and they don't have a big following and there's really nothing in it for me. But there's also, it's not just that there's nothing in it for me, because if he was, 30 years of experience or 20 years of experience and he had something to actually bring to the table from a longevity perspective, then I'd prioritize debating him. Now, I will say this, I'll probably end up debating the guy simply because nobody else will step up to the plate. So I'll give him a swing and we'll probably do that the first quarter of next year. Right now, I'm just so tied up in doing what I'm doing, running the agency, raising the money for the private equity fund. We're launching our project down in the Dominican Republic. So side note, anybody here that is an accredited investor in the United States, if you don't know what accredited investor is, it's you got to earn $200,000 a year of income for 2 years in a row and or have a net worth of $1 million outside of the equity in your primary home. So, but if you are an accredited investor and you're interested in looking at an opportunity that is the first deal in the Cashflow hacking fund that we're launching, it is an amazing opportunity that's going to provide over 20% cash flow and just huge returns. Best opportunity I've ever seen in my life. We're going to be doing that. So if you're interested, just reach out. You can email chris@cashflowhacking.com. If you are interested in learning about that, just give me an email and I'm happy to help you. But kind of getting back to the point here with IUL, the reason I was inspired to do this is I had a couple comments from several people over the past couple of days. And those comments were, just shut up already, focus on whole life, stop talking about IUL. We're tired of it. And that's that, right? Like, so people say this stuff. And so the challenge that I have with this is that it is the biggest double standard in the world, because people say they want me to shut up about IUL, yet I think, at least I believe, those people are just IUL people that are tired of hearing about it, right? Like, and I don't know, they obviously have some horse in the race, or maybe they're whole life people and they just want to focus on the positivity side of whole life. Now, one of the things that I want to do here is I want to go here and let's see here. I'm going to go to Life 180. I'm going to share my screen. I want to just do a little oops. I want to do a little, oh, my screen froze. I don't know what's going on here. My mouse, I think, died. Of course it did. No, there we go. So what I want to do is I want to do a screen share here. I'm going to go to my Life 180 account and I'm going to take a look at how many videos I have. I have 1,100 videos. Okay. You can see here that I have 1,100 videos on my account now. And out of these 1,100 videos, about 100 of them are focused on IUL education. I've got playlists, some of the playlists that you can see here. I've got Index Universal Life training playlists, which, is whatever it is. I don't know how long the training playlist is here. I would encourage everybody to go check it out. 75 videos. This is my training playlist effectively, right? And so when I look at this and people go, "Hey, Chris, you need to stop talking about IUL." It's like, okay, you see this one video, or, maybe there's a couple of the videos that I've created have been very focused on IUL. They've been very focused on exposing IUL influencers like Doug Andrew, like Curtis Ray, like a lot of these World Financial Group hacks that I see out there. And at the end of the day, my focus is just more about the industry. It's more about educating people about how life insurance can work in general as an asset class, right? So here's the deal. Sorry, I just got the chats up, and I want to make sure I keep up with what's going on. So here's my thing on this, is that like people, especially on YouTube, I think there's becoming this concept that people are just trying to maybe squash my voice. I don't know what the deal is, but the funny thing is, I go to the searches here, and I'll just like, let me type in Doug Andrew whole life. Okay, so, Doug Andrew, what is universal life versus whole life? Infinite banking with IUL versus whole life. So he does all these videos, yet somehow when he does them, people try to say like, oh, it's great because IUL is infinite banking, is better for infinite banking than whole life, when it's not the case at all. But it is people just I think confirmation bias is the best way to put it, right? King Cooper, thank you so much. Yeah, I will. I'm not going to stop. That's what I will say, is I'm not going to stop doing what I'm doing. But it's fascinating to me. It's mind numbing at the level of people that just don't realize this. David McKnight, whole life. Like if we type these in, these are all IUL people. Now they're going to be doing videos on whole life versus IUL, right? And they're going to be doing this of, oh, look at this, my video with Garrett Gunderson about David McKnight being wrong, right? So this is like, who else do I got here? Curtis Ray. He's probably the worst of the worst, right? Anybody know who Curtis Ray is? This guy. I got a video coming out on Curtis Ray tomorrow. Anybody want to see it? You should probably go check it out. This video actually right here, upcoming. So, wow, it's got it. That's cool. I've never seen that before. So the video is not even out yet. When you type in Curtis Ray whole life, MPI whole life reaction. Okay, that's cool. YouTube is awesome like that. I love the search engine capacity of whole life of YouTube here. So check this out. My passion is helping people have a better understanding for how life insurance works. My passion is, I believe that a properly designed whole life insurance policy is one of the most powerful assets in the world that you can utilize in your personal finances. Unfortunately, on the whole life side and the IUL side, there is so much misinformation that is being marketed and presented online at this point in time. One of the things I've really doubled down on is really just being more polarizing, being willing to put my head more out on the chopping block, to just call out truth and to just be bold about the fact that there is so much misrepresentation. There is so much misrepresentation about both sides of the products. Like, I know I give IUL a real hard time, and I'm not going to dispute that, and I'm going to keep doing it. I will give whole life insurance influencers a real hard time right now. There's a lot of conversation going on social media, whether it's TikTok or Instagram or YouTube. There's a lot of conversation going on around the fact that infinite banking and whole life and all this ability to earn positive arbitrage on loans and all these different things, and nothing could be further from the truth. That is not how it works. That is not the purpose of utilizing whole life insurance. I don't care if it's whole life or IUL. A lot of these people, and I just got done doing this big video series with Garrett Gunderson, right? And one of the things that I can say is that kept coming up in our conversation is the fact that wealthy people utilize whole life insurance. There's no debating that. Wealthy people did not get wealthy because of whole life insurance, right? And make no mistake about it, there's a huge distinguishing difference, right? Getting wealthy because of means the product itself made them wealthy. It wasn't the product that made them wealthy. It was the behavior. It was their investment strategies. It was the investment in themselves. It was the businesses they built, the real estate, the assets they invested in. Those were what made them wealthy. The whole life insurance is almost like just a backstop. It's a way that they can secure their wealth and guarantee that wealth is going to pass on to the next generation in the most tax favorable basis. And it's going to be a store, like a warehouse of capital that you can leverage and utilize based on the assets and the wealth that you've created to help compound that wealth. You're not going to get wealthy just by buying life insurance. I got news for you. It's not what life insurance companies do. They do not create wealth. So let me see here. I got a couple comments. Keep going, Chris. When I got out of my 401k, purchased whole life Guardian policy, IUL was not in the picture. They don't recommend it to me at all. That's good. My son has a UL. When I compare the earnings of my whole life cash value and I purchased them a month apart, his UL barely has any cash value versus my whole life has a large amount of cash value. Switch my son. Have your son call me. I'm happy to help him out. Just email chris@life180.com if you want to have that conversation. And I'm happy to set something up with you. That right there, here's the deal. IUL is really good at making unfulfilled promises. If you understand the history of Index Universal Life, then you realize that it is literally just a failing financial experiment. One of the things that I like to do, actually, I'm going to do this. I'm going to go to the board here because that's what I do. Let me just start a new screen and do this. So one of the things that I think is really important for everybody is to actually understand how Index Universal Life works, what the history of it is. And when we look at this, so I'm not gonna try to debate anybody. If you look at IUL on an illustration versus whole life on an illustration, IUL is going to win 100% of the time. But I always say life doesn't exist on a spreadsheet, right? And so what we have to look at is we have to look at the history of IUL. And if you look at the history of it, we look at, actually, you know what? I'm going to go back before this. The one thing I want to say is, well, let me ask you this. Give me a 1 in the chat if you think history has a habit of repeating itself. I think there's any chance that what has happened in the past is possibly indicative or at least a sign of what could happen as we move forward. So what happens is, and this is, man, I cannot write today, 1980. There we go. We'll figure this out. UL was created by E.F. Hutton. This is something that Doug Andrew talks about a lot, right? Doug Andrew likes to talk about the fact that, oh, I've been doing IUL for 45 years. Well, he has not been doing IUL for 45 years. He's been doing UL for 45 years and then switched to IUL somewhere along the line, probably in the early 2000s, right? And so if we look at 1980, from 1980 when traditional UL, Universal Life, was created, going all the way to 1997 when IUL was created by Transamerica, we have to look at, okay, why did they transition from UL to IUL? Why did they create IUL in the first place? And more importantly, why has UL completely fallen apart? Why? Where did the wheels come off of UL? Well, the wheels came off of UL in the mid-90s through the early 2000s. And so what's happened here is if you looked at UL, you could see this like if we look at like a growth curve of like UL in 1980, as far as like market share, it was really low and then it started going crazy and then it went up into like 1995-ish and then it just went right down. It plummeted. Why? Because all these policies, the UL policies, started lapsing. The challenge is nobody knew that they started lapsing until they started getting notices in the mail because they don't get notified. And unless you have an agent that's really checking in on you and telling you kind of what's going on, letting you know that you have to fund these things better and better and better, otherwise, or more and more and more, otherwise you're going to have a lapse issue and you're going to have to come out of pocket to avoid the lapse issue, which, by the way, if a policy lapses before you're 75 years old, for most of these policies, you're going to get hit with a big tax bill, right? History during the Great Depression, majority of the insurance companies held up while banks collapsed. Well, whole life was in existence. Yeah, whole life was in existence then. And I got news for you. Man. Okay, so thanks for bringing that up. So I'm going to come back to this, but I got to say this before I forget it because I will forget it. I read this thing the other day, and it was a comment from somebody saying that their FFL agent told them that Wells Fargo was the largest holder of index universal life in the world. They had $25 billion of IUL. This is an FFL agent, and this is just a comment, so it's a bit hearsay, so I'll acknowledge that. But it was somebody said that Wells Fargo had $25 billion of IUL. And really, Wells Fargo has $28 billion of life insurance on their books. They don't distinguish what kind of life insurance it is. So we got to be straight about that. It doesn't say they have whole life insurance. It doesn't say they have IUL. It doesn't say they have UL. It doesn't say any of that. But if we use a little deductive reasoning, we can surmise that these banks have been doing this far before UL and IUL even existed. And so the bulk of I'm not going to say they don't have any of the UL chassis products, because I can't prove that. In my conversations with people like Barry Dyke, who I've interviewed on this channel, who wrote the book, The Pirates of Manhattan, in my conversations with him, he's gotten a lot of research that shows that they have a lot more whole life than they do anything else. You can only prove it to a certain extent. You can't prove that they don't have any. And I'm sure different banks do it differently. But to say that these banks have predominantly IUL or they use IUL, it's such a smoke and mirrors conversation, because most of it is whole life, because they've been doing this for far too long to even consider that IUL is a foundational asset on their balance sheet. Furthermore, I use this as an example. If everybody's heard of a cash value line of credit, one of the things about a cash value line of credit, if banks liked IUL so much and they would buy it for themselves, well, that they would then treat your money better with IUL than they do whole life, or they'd probably treat it as well as they do with whole life. And think about it this way. If you go look this up, and I challenge anybody to do this, and this is just kind of part of my process on how I utilize my deductive reasoning to come to the conclusions and the research that I do. I go and I talk to banks that offer cash value lines of credit, insurance-backed lines of credit. Every bank calls it different. It's the Internal Revenue Code Section 7702. Yeah, but that applies towards IUL and whole life, right? It's all cash value life insurance, right? But here's the deal. When we look at the banks and we look at how banks treat IUL, and I think the easiest way to do this is to look at the insurance-backed lines of credit. And this was really big a couple of years ago. And in order to do that, so in order to really do an assessment and compare the two, we have to say, all right, if I had a whole life insurance policy and I went to a bank and I wanted to assign the value, right? Because the whole purpose of this, by the way, I guess I should give it a little background. When we look at why were people utilizing cash value lines of credit, is because a couple of years ago, you could go into a bank, and you could assign them the value. You could collateralize your policy cash value and collaterally assign that cash value to the bank. When you did that, they would give you a line of credit that would be easier to use. It would be faster. It's kind of like a HELOC. It would work with the expediency. You'd have a checkbook. It'd be much more convenient than utilizing the policy loan provision in the policy, all these things. And it would give you a better interest rate. You could get I had some clients that were getting 2.25% on a cash value line of credit. All the while, their policies were growing at 4.5%. Pretty solid stuff, right? The challenge is, since then, obviously, bank rates have gone up. Cash value lines of credit at this point in time have gone up to 8-9%. And so it doesn't make any sense unless the liquidity and the expedience and access and simplicity of using the money makes sense for you. Most people, that's not going to be the case. Most people are going to be in a situation where if they had the cash value line of credit and they had it collaterally assigned to a bank, they basically dissolved that and used a policy loan to pay it off, which was a beautiful thing, right? It's a great part about whole life insurance. Is it like, if you want to utilize it either way, whether you use a policy loan provision or whether you go partner with a bank and get the convenience of that, depending on what the interest rate environment is, you have the flexibility to go out and do that, right? The only other downside to a cash value line of credit was you had to actually qualify for it with credit, which was easier because it's backed by an asset, whatever. But here's the deal. If you go to any of these banks, and I encourage everybody to go out and do this, if banks loved IUL so much, they'd be handling the cash value lines of credit a lot differently than they do. They will assign 95 to 100% of a whole life policy. They will lend you, they will give you a line of credit for 95 to 100% of the cash value that you have in your whole life policy. Most banks will not even give a cash value line of credit against an IUL. I found a couple that do, but out of the couple that are able to and willing to do a cash value line of credit against an IUL, they'll only allow you to do a 70% max. One was only 50%, one was 70%. So if a bank looks at an IUL and they go, oh, if we're going to lend against that, there's a lot more risk, right? Because that's what they're saying by only willing to allow you to collateralize a smaller amount. That is simply saying that it is riskier to take loans in an IUL or from or against an IUL than it is to do it against a whole life policy. If there's no other proof in the world, that right there should tell you everything you need to know about the danger of IUL when you're taking policy loans from it. If policy loans were as safe as they say they are, if they gave this arbitrage as consistently and predictably as these agents on TikTok and YouTube and Instagram were saying that you could, then banks would be much more willing to allow you to collateralize a high percentage of it. Because if there was no downside risk, why wouldn't they just let you borrow against it and leverage it? It'd be free money for everybody. But that's what these influencers want you to feel like, right? But that's just not how it works, right? So I think that's something I wanted to get off my back, because that was bugging me for a couple of days. You can imagine I get so many comments on this stuff that it just eventually my head just wants to pop, right? And I gotta figure something out. So all right, I'm gonna read this comment. So read Doug Andrews' book, A Starter Kit to Becoming a Millionaire, Misfortune 101. Oh boy. If you read the book, he tells you to use your home equity to start an IUL policy. Yeah, so that book, right, by the way, Shernian, is that how you say your name? Thanks for the comments. If I hopefully I said it right. I always hate being disrespectful to people's names, but that book right there got Doug. Just go Google Doug Andrew lawsuit, and you're going to see a lot that came out of that problem right there. That tells you right there, IULs are not a good investment. What's not true? Tell me what's not true. King Cooper, tell me what's not true. I don't know how much lag or what you're seeing on the video. That tells you right there, IULs are not a good investment. Most people don't have a large amount of cash, as he stated in his book. People stop watching video, and read and do your own research. Yep. So I don't know, King Cooper, if you're alluding that the cash value line of credit thing isn't true, because that's what I was just talking about with IULs. If you have, I'm just telling you the research. I've literally looked at 25 banks that do cash value lines of credit, insurance-backed lines of credit, whatever you want to call it. Just go Google those two phrases. I've found a couple banks that do IUL. Most of them have smaller, will only lend against a smaller percentage of them. And whole life will be a much higher percentage. And so that, I don't know if that's what you're alluding to. If you have a bank that will do otherwise, then let me know. I'm always happy to look at it. Once again, I'm just telling you the research I've done. I'm not saying anything with absolute terms, period. So there's that, right? I think that's important to understand. So as we get into this, no, I don't want to do that. As we get into this is the button I need to hit right there. Here's the deal. If we believe history has a habit of repeating itself, we can basically kind of extend this out and say 1997, right? And I'm going to switch and I'm going to say UL was created, and it had basically no market share till 2009. And then it started going up, right? And that is what it is. But as it's gone up and as the market share has gone up, the problem is IUL performance has come down. This is one of the reasons I did the IUL challenge. It's one of the reasons that I'm so passionate about doing what I do. I entered the life insurance business right here. I worked with National Life Group. I got in as a regular agent, became the director of business development, had a lot of success till 2014. I decided, wow, this isn't what I think it is. I left the IUL space and I joined the whole life industry from then to now. And actually, I ended up giving up my license in 2016 for a lot of reasons that I've covered in other videos. We don't have time for that right now. So, it is what it is. I'm seeing King Cooper's comment. What's a good time to chat? There's a lot of misunderstood information. You're comparing apples and oranges. I'm not comparing apples and oranges. I mean, I'm happy to talk, but I'm not comparing apples and oranges. Tell me what I'm comparing that's apples and oranges. I'm comparing cash value lines of credit for both different types of policies. They both it is what it is. I'm happy to talk to you. Just email Chris at Life180 and we'll set something up. But at the end of the day, I ended up joining the whole life industry and becoming that actually it was about 2021 that I joined the whole life industry. And from 2016 to 2021, I literally just created content educating people about how IUL works based on what I discovered in my role as the Director of Business Development for National Life Group during this period of time, and just trying to share it with the world. The reason I gave up my license in 2016 was because of a lawsuit that I had with National Life Group. And I had to either give up my license after I had just won a lawsuit against them, or if I didn't give up my license, they were going to sue me again and just try to bury me financially. My attorney basically said, you have to give up your license. Otherwise, they're going to keep coming. Just give it up, let the statute of limitations dissolve, and then get back in, right? And so that's basically what I did to navigate this process. And so that said, here we go. When we look at IUL now, what I think is going to happen, and I think I've got a lot of factual history that shows how this is going to work, is that the policy performance is going to get down and down and down. It's going to go worse and worse and worse and worse. I've got videos that I'm putting together right now showing that what happens is these companies use high cap rates to market, and they write these off as marketing expenses. Not every company does this, by the way, but I will say Midland is one of the companies that does this pretty extremely. I've got several policy statements showing policies that were sold with 12.5% cap rates are now 7.5% cap rates, 7.5 and 7.75% cap rates. All the while, Midland is still marketing products at higher than those rates for caps, right? So it just goes to show that they do not have to be transparent about what happens to these products after they get put in force. And that is a big deal. And there's another, actually, Life Product Review, Bobby Samuelson just did another article today about a company that did exactly this. They dropped the caps on in-force policies, right? This is a huge deal, okay? And so what I was talking about, though, before I started this is that when we look at 1980 to 1997, and we look at the UL chassis and then UL going away, basically, and being replaced with IUL, my question is, what happened to all the UL policyholders? Where did all they go? How did the life insurance companies treat them, right? There's a lot of conversation about life insurance companies having this level of morality, right? About life insurance companies having this huge history of financial stability and security and success. And that's why you got to put your money with a life insurance company, because when you put your money with a life insurance company, you're putting your money with the most stable financial institutions on the face of the earth. Well, with a whole life insurance policy, that's absolutely true. You're basically hopping on the back of a financial gorilla that's been successful since 1842, over 180 years, and you're participating in that success. That is the whole idea of getting a dividend. You are participating in the profit of the life insurance company through a dividend, which they've paid every single year since the institution of the company, right? Some of these companies are 180 years old, some of them are 100 plus. But my rule is I won't work with a company that is under 100 years and doesn't have a successful track record of paying a dividend every single year for 100 straight years. That goes all the way back and precedes the Great Depression, right? So if we have that kind of success, it's pretty easy to say that it's going to continue. The problem is IUL agents like to borrow that statement. They like to borrow that success, and they like to hijack the success that whole life insurance companies have had, and they like to put IUL in the same category. And the problem with that is that when you are a policyholder with an IUL, you are no longer a business partner through sharing in the profitability of the company, you are now a profit center. The problem with IUL is that IUL companies will still succeed. The whole idea of insurance companies being successful and thriving on and being successful in any market environment, that's not going to change. The problem is the IUL policyholders are not guaranteed to participate in that success. And when you look at UL and you look at how these IUL or these UL companies, which by the way, most of the companies selling IUL at one point in time sold UL. That's what they made the transition. And if you look at how they treated the UL policyholders back then, I don't know, like it just proves to me, if you think they're going to treat the IUL policyholders any differently than they treated the UL policyholders, you got another thing coming. It's not going to happen. It's going to be the same thing because that's just the way these companies work. If I told you the amount of conversations I had with attorneys that are dealing with lawsuits for people that are going through problems with their IULs right now, and the fact is, like, these people were missold, but then the companies are basically saying, well, it's all in the illustration. It's all there. You signed off on it. You knew, you should have known what you were getting involved with, because all the problems that you're having, all the lack of performance in this policy, it was all in the illustration that was a possibility. It was going to happen to you, right? But nobody reads the illustration. Why? Because IUL illustrations, whole life illustrations, 18 pages long. Anybody can get through it because it's not that complicated, because a lot of them are just ledgers. In an IUL illustration, a lot of those are 60 plus pages, especially if you get the income report and you have any kind of income illustration out of it. You do all these other reports that they get in there, all the expense reports and everything else. They get 60, 70 pages long. I looked at an IUL illustration the other day that was 82 pages long, right? Is it possible that both IUL and whole life can be designed poorly? Yes, 100%. Whole life can be designed poorly. IUL can be designed poorly. The difference is, with whole life, a poorly designed whole life policy will always be bailed out with time. A poorly designed IUL will blow up in your face, period. Like, it's almost impossible to bail it out without throwing a lot of money at it, right? Like, all companies were sued against, like, you're not going to find an IUL company that hasn't been sued on some level or hasn't settled a lawsuit and sealed it in arbitration or something of that nature. They all do it. But Matt, you asked, is it possible that whole life and IUL can be designed poorly? Yeah, I mean, absolutely. The answer is yes. My statement to that is a whole life insurance policy is poorly designed if it's not in alignment with your values and your beliefs and your goals and objectives, right? And so, I had a guy this morning ask me to do a policy design for him. He wanted the max death benefit in a whole life policy. It wasn't about the cash value. He didn't care about cash value, right? So you have to understand why you're designing it for people. And so for him, he just wanted the highest guaranteed death benefit on a permanent basis that he could possibly get. He was thinking more of a legacy play. It's a different conversation, right? But if somebody just sent me that illustration for somebody, and I was looking at it through the lens of banking, I would look at that and at that illustration and be like, oh my gosh, this is horrible, right? So you have to understand, like, what are the goals and objectives of the individual that we're looking to do the policy for. The difference is, with a whole life policy, what happens is, over time, you have the guaranteed chassis, and it's going to, the dividends are going to get better and better and better every year. A poorly designed whole life policy is going to have very little cash value the first 2 to 5 years. And then from there on out, starting in year 6 or 7, the cash value will begin to grow. Typically, even in a poorly designed policy, the cash value will begin to grow in year 7 or 8, maybe at the worst, by about what the premium payment is every single year. So that's not a bad thing. The capitalization phase is too long, then that's a poorly designed policy, right? Like, if you want access to the cash, but the deal is, along with whole life, the longer that you keep it in force, time bails out poor design. With IUL, time destroys poor design, and that is the problem, right? If the goal is life insurance, IUL is not the vehicle, either whole life or GUL. Too many levers. Agreed. I like GUL. It is absolutely a good product for especially older people that are looking to just do like a permanent term kind of scenario and level out that premium. That can be a great way. Even whole life for older people tends to be too expensive. But if you're younger and you want permanent life insurance, then whole life is good there. The challenge is most people who are younger typically are not in that stage of thinking about just permanent insurance at that point in time. They're thinking about wealth creation, right? And that's a challenge. And so, Brian, I did say Brian's here. So Brian, if anybody was here at the very beginning of the video, Brian, you can watch a replay just to vet this if you want. But I did say I was frustrated at all of the agents that were not willing to debate me. The David McKnights, the Doug Andrews, the Curtis Rays, all these people that have big mouths and like to run them and don't want to back it up. Brian, you and I disagree on a lot of things. I'm still waiting to see the illustrations that you said you'd send me. I'll send you some of my own if you want to see them for you. But I'm very curious to see, the best design that you can make for a 43-year-old. I don't know how much a year, like 25,000 a year or something like that into a premium, and give me the best design possible. Maybe do like a $100,000 front load into it. $25,000 a year premium until from 43 to 60. And then I want to see the income that you would suggest that I take out of it. And I want it illustrated. And then I want to compare that to what I would do, with the cash flow hacking stuff, because that to me, I just, the danger in IUL loans in retirement. And I know you love to talk about the corridor and dropping the death benefit and all this stuff to reduce the net amount at risk, but there's still risk outside of that. Bottom line is nobody else is willing to debate me. Brian is the only guy who's stepping up. I've hesitated because Brian honestly just doesn't have a following. And, and honestly, Brian, no offense. I think you mean well, but you've been in the business for about, what, 3-4 years. And so it's really hard. Front load is not good though. You have to spread it out, spread the front load over 4 years. All right. So you just tell like how you design it. If I said I have $100,000 and I want to get that money deployed as fast as possible and I can afford $25,000 a year, you just do what you say you would do. And then I want max income. Like let's assume this isn't, this makes me sick even saying this, but let's assume I wanted to use this for tax-free income in retirement. Like just do your best, right? Like that's what I want to see. And that's it. And then we'll go from there. And what I was saying though, is like all these other guys aren't willing to debate me. I've been pushing you off, Brian, because, well, you had no following and you've been in the business for a very short period of time. And so, to age 60 for me, and then income. And so, that said, Brian's been doing, content. He's been creating stuff. I've seen your Spotify playlist. I don't know how old or how much you've gotten going on there, Brian, but, I will say I don't agree with everything you say, but you're stepping up and you're willing to do it and nobody else is willing to debate me. So early next year, when I'm done, when I get through launching my private equity fund, because I just launched my 506(3)(c)(1 Reg D 506(3)(c)(1 private equity fund. We're buying a hotel. Anybody who's an accredited investor that's looking for an amazing cash flow opportunity, reach out to me, chris@cashflowhacking.com. But we're doing that. So I'm in the process of doing a $3 million raise for that. When I'm through that, I will take some time and we will debate. Maybe I'll have you come down to the Dominican Republic and we could do it in my new podcast studio while we're down there. And that will be a fun little debate to do because nobody else is willing to step up to do it. And so at least it'll be content and at least it will be, information out there for people to be able to really have transparency on this thing, because that for me is the kicker for most of this, is that there's so many people that have all these opinions that want to put it out there and nobody's willing to back it up. They're not willing to have live conversations, which to me is just cowardice. David McKnight to me is the worst of the worst because he calls me out. Like I would get it if Doug Andrew came at me because like I called Doug Andrew out first because I think the guy's a crook. And I think his methods and his concepts are criminal. And I think you look at his history, just go Google Doug Andrew lawsuit, right? This is the thing with Brian that I don't get, bro, is like You say a lot of good things, and I think you mean well. But then you tell me that you learn everything you learn from Doug Andrew. Yet all you have to do is go Google Doug Andrew lawsuit, and you see what kind of character that you're following and the kind of person that you're implementing their strategies. And you don't sit and question like, I've been in this business for 4 years. Maybe I should question this. Maybe there's something to this. That's the part that I have a hard time with you. Brad Burnett asks, can whole life be used as a supplement source of income in retirement? Yes. Supplemental. Yes. Not primary. Life insurance should never be the main source or even a regular source of income in retirement. This is one of my biggest problems with IUL, right? So when we look at how you can utilize whole life as a volatility buffer. So the idea is you have different asset classes, right? Like you have investments. So the old idea would be that you would have investments and then bonds, right? And so the idea would be 60 40, 60 or 60, 40, depending on what your risk tolerance was and kind of where you were and what return you needed and what the fixed market interest rates were and all these different things, right? And so you had this going on, but the problem is investments, the idea is on good years, you would take money when times are good. You would take money and you would do all your income distributions from your investments. The idea is on negative years, you'd be able to take distribution from your bonds and all would be right in the world. The problem is the past 2 years, both investments and bonds have lost, right? That had never happened like that before. So the whole idea of bonds being a safe place for your retirement is basically dead. It's just exposed how much risk is there, right? So my philosophy right now is just saying, hey, replace bonds with whole life insurance. And that shouldn't be everything in your portfolio. It should just be, 40 to 60%. I would just say 40%. Honestly, I wouldn't go 60%. I know a lot of people say that. I'm not comfortable going that far with it. 40% of your retirement. It replaces the bond portion of your portfolio. And because the standard deviation, meaning the chances of it losing or ever losing money, is like nothing, right? Like you will not lose money. So this is always going to be there. So the idea is you leverage this through policy loans or withdrawals up to cost basis and then policy loans on negative years. My idea is having 6 to 7 years of income in a whole life policy to be able to do this, to be able to get that kind of money and be able to support other investments that you have. But that is a supplemental strategy. It is not a primary source of income in retirement, right? So that's really important to understand the difference between those two. Alberto Orozco, sorry. I don't know why I read that name so fast and so wrong, but I apologize. How about using a properly designed whole life for paying off debt faster? Good idea or not? This is one of the more complicated, abrasive questions. Not abrasive. Yeah, it's a tough one because there's math and then there's life, right? I used the phrase earlier, life doesn't exist on a spreadsheet. So, all right, let's do this. So the challenge is this. I'm going to go back to the board again. I'm going to try to come up with like an analogy here to kind of explain this really cleanly. So let's say you have cash, and then you have like cash flow, okay? And let's say your cash flow is 20K per year, and let's say your debt is I don't know, let's say you have 40K in debt. And I'm not going to count mortgages as debt. Let's call it other debt. Oh, it didn't go all the way. Sorry, I keep hitting these buttons wrong. So we have these 40K in debt, not including your mortgage, right? And then we have the idea here is like, let's say this debt you're paying 20% on, which right now for credit cards is not that uncommon, sadly, for a lot of people. And so the idea here is saying, well, with the interest on this, on 40K of debt, 20%, basically that's 8K per year. Although it's going to be more than that because you're talking about amortized interest, which is going to cost you more than 8K per year at the end of the day. But you have this 20K. In a perfect world, this 20K of cash flow should be able to pay this off in about 2.5 years, right? That's about what you will pay it off in if you just took all 20K and paid that debt, that toxic debt off. So a lot of people will say to you that you should put money into a whole life policy. Or some people say IUL. Please never do this with an IUL, especially. I'm going to caution you against doing it with whole life unless you know exactly what and why you're doing it. IUL, just never do it, right? So when we look at a whole life policy, what are you doing? Like most people are going to say, all right, we got to do a 40-60 blend, which means 40% paid up additions or base and 60% paid up additions. So out of that 20,000, we're going to have probably 12K of cash value, right? So what happens is we've now lost 8K of cash value accessibility to accelerate paying that down. So the problem that most people that utilize debt elimination softwares that bring into the equation utilizing whole life insurance, they don't take into account that when you're going to lose this 8K, but on top of that, this 12K, you're going to have an interest expense that goes along with it that you're going to have to pay on top of this 20%. Now, yes, sure, granted, that money is going to be compounding, and there's no doubt about that, and there's definitely value there. And if you think long enough term, it can absolutely work out if you're disciplined enough. My general rule of thumb is that this is pretty seldom that this happens, is that my rule of thumb is saying if you can't do a front load into a policy that covers this debt and basically refinance this debt in the policy, it typically doesn't make sense. The best bet is to go out, get a convertible term policy, lock in your net worth. That's basically your human life value. That's what I say, buy your net worth, lock that in, and then utilize, and you're going to be able to buy this for a fraction of the cost, right? So lock that in, and then you're going to utilize the cash flow that you have left, which will be basically almost as full 20K, maybe 19K and change, pay that off. Once the debt's paid off, then convert this term policy to a properly designed whole life insurance policy, and you'll be good to go. That's the way I think paying off debt with life insurance or utilizing it or it's not even utilizing life insurance to pay it off. If you don't have the cash flow and you have a lot of toxic debt, pay that debt off first. The compound, the opportunity cost of having that high interest debt working against you is typically so negligible, and there's something to be said for getting fast results. Once again, if you said, "Hey, I want to have a lot of growth and whatever over a long period of time, getting started early," if you understand there's an opportunity cost on the front end, yet there's the big growth on the back end. If you have a long enough term vision, outside of just the spreadsheet and outside of like the math of it, there are reasons that you could convince me that you personally want to use a whole life policy to pay off your debt. But I'm going to tell you, mathematically speaking, it typically doesn't make sense unless you're able to do a front load into a policy, refinance that debt into the policy, and pay the policy loans back instead of paying the credit card company back, for instance, right? That's the deal. Charles Newton, what's up, bud? Do you know what bare minimum rating you would need to get from a whole life insurance company to achieve bond-like returns? I'm assuming getting suboptimal rating will not allow the policy to perform as well. Maybe 60-40 stocks to bonds rate. So the idea is like, all right, if you're not healthy, is this the question? If you're not healthy, what kind of health rating would you need to get? Would it be table B, table C, table D? The answer is it really depends. Depends on the blend of the policy. The worse the rating, the more tricky you got to get with the paid up additions, the more tricky you got to get with the term riders, the different term blends potentially with different companies. It also, beyond the rating, it has to do with age. So yeah, it could get really tricky if you're 55 and you're rated and the cost of insurance is high. You're probably going to have a hard time pulling that off, right? So that's why this is a privilege to be able to do it. It's not a guarantee that you're going to be able to do it. If you're younger, say 35, and you have a table B or table C, you could probably do a higher paid up additions blend and a lower base, and and over a 30-year period, you're going to come out just fine. But you got to just look at it. There's so many variables to that based on age and rating and the amount of funding that you're doing, policy design, front load, not front load. Front loads obviously add term riders to it to be able to take the front loads in without meching it. But then if you're rated, the term rider cost goes up. So now you have to take all of that into consideration. And so the answer is I don't know exactly what the numbers are as far as like, what is the rating that you could pull that off. But at the end of the day, I would say it definitely is doable for somebody who's a table B or table C rating. Once you get to table D and beyond, it probably gets a little tough just because the cost of insurance start to be 250% more than normal. And that is obviously prohibitive to cash value growth because that drag of the cost of the insurance inside of the policy itself is tough. But once again, if you're young, that's where age comes in, because time is the healer of all things in these policies in whole life. The problem is typically the people that are not healthy are typically older. And so that's where the problem comes in, is not necessarily the health rating, but the combination of the health rating and the age to not give it enough time to make up for it. So the mortality charges and expenses inside of the policy are compressed because of the age. And then you add the health rating in on top, and that compounds a problem versus if they're younger, you're compounding a not so expensive problem, right? And so time makes up for that. Hopefully that makes sense. Just something to think about. So Brian, I'm seeing your messages. Yeah, man, I hope you can make me that illustration. I'm happy to do that. Once again, I look forward to debating with you next year. Give me a thumbs up if you say you can come to the Dominican Republic, and we will do it down there at my new podcast studio. Everybody else, tell me what your thoughts are. So I wasn't going to debate Brian. I was actually I was on the phone with Caleb Williams the other day, and we were talking about it. It's just my frustration about David McKnight and people, and it was interesting. And I had to honestly just kind of hold myself accountable, and Caleb helped me see this. So I'll give Caleb credit. And Brian, you should thank Caleb because he was just like, listen, man, debate Brian, just debate him. Because I was sitting here just like basically complaining and about the fact that David McKnight and Doug Andrew and Curtis Ray, they're all chicken and they won't debate me. And in David McKnight's situation, I mean, to me, he's a coward. Like, you don't call somebody out and then not back up the fight that you picked in the first place. To me, that's just cowardice at its finest level. Like at the purest level, that's just cowardice. And it's just, to me, should not be allowed. You shouldn't be able to go up and slap somebody and then run away, right? Like, and not stand up for what you did. So there's that, and listen, I pick on people, or not pick on people, but I'll pick a fight with somebody that I think is wrong. But I'm never going to back down. Like, if I'm going to go after Doug Andrew and Doug Andrew said, hey, let's do a debate, I'm going to go have that debate. I've said I'll show up anywhere. My problem with David McKnight is he just won't do it. And so and then he finally, actually, let me find this real quick. I got to go. If you're following me on Instagram, I put up a video on Instagram talking about this. And David actually, the craziest part is David is responding to me. Like, this is the mind-numbing thing. David McKnight is actually responding to me and chatting with me in YouTube and Instagram. And it's nuts. Let me see here. So he goes here. Oh, I got to turn it down. So he says, thanks for the respectful dialogue. I will address this in a coming video. So I can't wait to see him make another video on this. This will be interesting. And then I gave him a thumbs up. And then I said, David McKnight, because I tagged him, why don't we just set up a live debate with a moderator? Makes sense to me. And then his response, because I have nothing to gain by debating you. So that on its own says, if I have nothing to gain, it's not about truth. It's not about the industry. It's not about transparency. It's about him and his brand and his recognition. And it's all about him, period. I have nothing to gain by debating you. Actually, you kind of do, because I got more YouTube followers. It would build your audience. There were a lot of things that would happen. I can't express this any more clearly or sincerely. You continuing to harp on me with social media does not entice me to want to engage with you in that format at all. I posted my video. You posted yours, your 2 response videos. Let's just call it good. It's not going to work with me. I'm going to tell you right now. So I wrote back. I wrote, call it good. You started this fight by implying that I was a predator, because he did. That's how he started his first video. It was pretty crazy. I said, you didn't know me. Ironically, you were somebody in the IUL space that I was going to leave alone. I will say that you are way better than Doug Andrew and Curtis Ray. I was, after all, exposing them, but I was leaving you alone. Then you made a video on me, and your positioning was full of deceit, in my opinion. You picked a fight with the wrong guy. You made it personal. And you're right. You have nothing to gain because IUL strategies will be exposed as supremely flawed. I'm not gonna just call it good. People deserve transparency and the truth. Maybe next time, don't pick a fight with somebody you are not willing to finish it with. I have no issue with you making a video on me. Lord knows I make videos on other people. But I will never make a video on somebody and then not be willing to back it up live. To me, that is cowardice. And so I'm just sharing. This is like open dialogue with David. I'm trying to make it real. I'm trying to just create good content because nobody else will do it. I'm going to give Mr. Brian Jarrell a shot, and we're going to have a debate next year. So, yeah, it'll be fun. Any other questions? I'm gonna get rolling. I got to make some videos on my investment fund that we're launching here for some marketing for that. So anybody interested in that, just shoot me an email, chris@cashflowhacking.com. If you want to reach out, get any information on that. I've got a video already that goes through the pitch deck kind of opportunity on what the investment looks like. It's only for accredited investors, just as a heads up. If you are an accredited investor and you're interested, just reach out to me. The cash flow investment in this fund is like nothing else that I've seen. It's unbelievable. And that's not just hype. Go watch the video. I'll share it with you. Email me and I'll send it to you. It's not public. I'm not making it public yet. I will create a public one, but it's not ready yet. So, all right, guys. Well, thanks so much. Hopefully everybody found value in this. The one thing that I didn't finish completely, and I feel like I just need to tie a bow on, is right back here, talking about this. When these policies lapsed, when the UL policies lapsed, okay, when these UL policies lapsed during this period, life insurance companies knew they were going to lapse, right? And if we look at how IULs have performed since they became popular in 2009, cap rates have gone from 12.5. Actually, back then they were 16.5 to 18% cap rates, and they've dropped to about 10%. The IULs have underperformed illustrated rates. That's one of the reasons I created the IUL challenge. Just go look up hashtag IUL challenge if it's your first time here, and you'll see what I'm talking about. And so they've underperformed, and I would even go so far as to say that IUL has been bailed out by the bull market. That's it. IUL has been bailed out by the bull market. And with that in mind, what's going to happen when the market goes bad? What's going to happen over the next decade when they're not bailed out by these higher caps at the beginning, and caps are lower, and the market is going to be in this really hurting place? Because at this point in time, there's a couple things that need to happen. Either caps go up. Well, if caps go up, what does that mean? That means interest rates go up. If interest rates go up, that means market performance goes down. So it doesn't matter if caps go up because the market's going to go down. So therefore, you're not going to be able to participate as much in the market success. And so that's going to have a negligible effect. I've done videos on this. I don't have time to get into it all right now because I do have to get going. But at the end of the day, there's 3 different scenarios that I cover. And if you want to know, just leave a comment in the actual comment section, not the live chat feed, because I can't see that after the fact. Leave a comment on the video itself, and I will copy the link to the video where I go through this in great detail. The 3 different the reasons that IUL is doomed moving forward over the next decade. And that is that. And because I'm telling you guys, these companies are going to treat IUL policyholders the same way they treated UL policyholders. It's not, I don't know how anybody can negotiate that. Tony, Patty, what's up? I'm getting a lot of LinkedIn people today. This is kind of fun. Can you do a video for people who already have them and what we can do from there? So the answer is that, Tony, I've done videos on that. I also have a website. It's called rescuemyiul.com. And it's something that we do for free. If you have an IUL that you want to get a review on and get free coaching on, sometimes you're stuck in the IUL for a period of time to get out of the surrender period, just to get through it. And as the surrender gets lower and lower, it makes sense. Sometimes you're going to have to take it on the chin and lose money because of the surrender period. And sometimes, you can just 1035 exchange whatever cash value you have because you've realized that this asset is not really what you want, what you thought you got involved with in the first place. So that's that. Hopefully that helps. Go to rescuemyiul.com. Actually, I'll put, I know it's a, cancel. Let's do this. Rescuemyiul.com. Oh wait, Tony, you did that in LinkedIn though. So I don't know that is going to go on there, but I'll just write it out. It shouldn't be very complicated, but I just feel like just to be thorough, it's rescuemyiul.com. Check it out. Go there. If you have any questions, we're happy to give you a free review and help give you some coaching through it. I've got a team that handles that just basically all you have to do is upload your current illustration and then the original illustration, like a current in-force illustration, so we can kind of see where you are now. Also show the original illustration if you have it. It's not necessary, but whatever documentation you had with it when you first sent it, that gives the team enough information to be able to kind of have what we need to be able to guide you in the right way. It's not just about replacing policies. It's not just about getting you out of it and getting you into whole life. Heck, sometimes, you realize that you don't have the cash flow and you need to do what we did and talked about earlier about paying off debt with other stuff and getting maybe a convertible term policy and get your financial foundation under you. I don't know where you're at, Tony, but just realize there's a whole process. We'll get your back. Just go to rescuemyiul.com and we'll help you out. So, all right, guys, hopefully that was helpful. Hopefully you found value in it. I had a lot of fun as always. Thanks for chiming in. Thanks for the participation. And Brian, if you're still here, look forward to debating you early Q1 next year. And we'll go from there. Have a blessed, inspirational day.